In the world of Forex trading, the surface is often cluttered with numbers, charts, and economic data. However, beneath this facade lies the intricate and fascinating influence of human psychology. As Thomas Oberlechner points out in his insightful book, achieving success in the foreign exchange market isn't solely about technical know-how or experience. It's also about understanding the human psyche. A successful trader might stand out due to innate traits and instincts. Some might be bolder in taking risks, while others might make more accurate decisions by trusting their intuition. In real life, traders like Nick Leeson, who took excessive risks trying to recover losses, ended up causing significant financial catastrophes. This highlights the critical role of investor psychology. Understanding the expectations of market participants is crucial for traders. They constantly try to grasp what others are thinking and how these thoughts might influence the market. This understanding is a fundamental aspect of market psychology. Markets can be swayed by rumors, which directly impact traders' decisions and thus dictate market direction. Therefore, thriving in the Forex market isn't just about technical analysis, it's also about grasping the psychological angles. The Forex market is akin to a battlefield, and those unprepared psychologically face a tough journey ahead. The decision-making processes in the Forex market reveal that currency exchange rates are deeply rooted in human thoughts and emotions. Behind every investment decision lie a person's thoughts and feelings. This implies that the key to understanding the market is understanding why and how people make decisions. A common belief among traders is that understanding what everyone else is doing and why makes it easier to predict future market movements. This clearly underscores the importance of psychology in the Forex market. The book draws on extensive research conducted in Europe and North America. These studies reveal that traditional economic theories fall short in explaining the real dynamics of financial markets. Especially during financial crises, emotional responses and social dynamics take center stage. This indicates that market participants can stray from rationality in their decision-making processes. Thus, to comprehend the Forex market, one must focus not only on economic theories, but also on psychological and social factors. In the financial world, the concepts of rationality and efficiency are hotly debated. Traditional economics assumes that investors are rational and markets are efficient, meaning investors act entirely logically, and markets reflect all available information in prices. However, in reality, these assumptions don't always hold true. Sometimes, investors act based on emotions rather than information, which can significantly impact their financial decisions. This is where psychology steps in. People often use mental shortcuts or are swayed by their emotions when making decisions. For instance, an investor might hold on to stocks even as the market drops, suffering more losses because of an emotional attachment. Moreover, there is evidence against the theory of market efficiency. Investors can outperform the market with simple trading strategies, or unrelated news might affect prices. In recent years, behavioral finance has challenged these traditional views, focusing on the relationship between financial decisions and psychological factors. This contributes to a more realistic understanding of markets and helps investors manage their decisions better. Investor psychology in the Forex market presents an intriguing debate about whether markets are rational. Investors often find themselves influenced by psychological effects, leading to deviations from fundamental values in market pricing. For instance, Daniel Kahneman and Amos Tversky's framing effects show how decision-making processes can be influenced. These effects significantly impact investors' risk-taking tendencies and the price fluctuations in the market. Technical analysis is a method investors use to try and predict future price movements. However, this approach often leads to faulty conclusions. Investors might interpret market movements irrationally, contributing to unsustainable price changes. Alan Greenspan's concept of irrational exuberance voiced concerns over markets potentially being overvalued. Lastly, while arbitrageurs aim to profit from irrational market pricing, this isn't always a successful strategy. Arbitrage opportunities in the market can be limited, and this strategy might sometimes result in costly outcomes for investors. Therefore, market rationality can vary depending on the time frame and market dynamics. For many investors, the Forex market is seen as a complex and unpredictable realm. One underlying reason for this complexity is the market's irrational behavior. With the increase in international investment flows, more individuals and institutions with access to money are entering the market, exacerbating these irrational conditions. Specifically, the rise in speculative motivations and the rapid flow of information often doesn't allow traders enough time for rational analysis, making market movements appear illogical. These market behaviors stem from the diverse needs and motivations of participants. Since every trader has a different goal, market movements can be interpreted in various ways. This underscores the importance of market psychology. Market psychology involves not only economic theories, but also participants' subjective experiences and psychological dynamics. Therefore, to understand market participants' decisions, one must look beyond rational models and consider psychological factors. This approach can help us better comprehend the true dynamics of the market. When trading in the Forex market, every decision is like a psychological battle. Forex traders experience something vastly different when they are in the market and taking real positions compared to an outsider looking in. At this point, focusing solely on outcomes like exchange rate movements or trading volume isn't enough. What's crucial is how these decisions are made. The psychological aspect of trading is shaped by investors' emotional responses. Many investors note that their best and worst decisions are often driven by emotions. Successful trading decisions are linked to accurate market psychology predictions, while poor decisions stem from incorrect assumptions. This highlights the importance of emotions and market psychology over analytical thought and economic fundamentals. The decision-making process is also influenced by social factors. Group dynamics can affect individuals' decisions, sometimes increasing risk-taking. Investors might engage in actions within a group that they wouldn't undertake individually. Therefore, emotions, market psychology, and social influences are key factors determining the quality of trading decisions. The psychology behind decision-making in financial markets is shaped by individual and group dynamics. Investors are often guided by social influences and emotional processes, indicating that psychological factors play a more significant role than rational thought in their decisions. This underscores the importance of social processes that affect investors' decisions. For instance, people often take riskier decisions within a group. This is because individuals tend to develop more extreme views under the influence of the group. Just like how we might take a bolder step under the influence of a group of friends, investors can be similarly affected. Another crucial point is the decisive role of emotions and intuition in investors' decisions. For example, when an investor senses an economic crisis, they might instinctively turn to safer havens. Lastly, market decisions are filled with uncertainty and complexity. Therefore, investors use various mental shortcuts to make smart decisions. It's akin to finding shortcuts to solve complex problems. These psychological and social dynamics profoundly impact investors' decision-making processes and play a critical role in achieving success in financial markets. In the Forex market, psychology vividly demonstrates how decision-making processes are influenced. Participants can make different choices based on how they frame their decisions. For example, the presentation of a treatment method, whether it's the number of surviving patients or the number of deceased patients, can significantly impact decisions. This operates similarly in financial markets. It becomes apparent that decisions are shaped not only by economic models, but also by psychological factors. In Forex trading, individuals' decisions are influenced not just by their own thoughts, but also by social effects and herd psychology. Traders observe others' decisions and align with them, creating a homogeneous behavior pattern in the market. These social dynamics, coupled with uncertainty and the fear of regret, increase the tendency for individuals to join the herd. As John Maynard Keynes famously said, "In the long run, we are all dead." But within the constantly shifting dynamics of markets, individuals' decisions are shaped by these social and psychological influences. Hence, herd psychology and social dynamics play a critical role in decision-making processes in the Forex market. In the financial world, especially in Forex markets, herd psychology is a striking phenomenon. Here, certain individuals or institutions, sometimes intentionally and sometimes unintentionally, can cause a stir in the market. For instance, when a respected economist makes a statement predicting a currency's value will rise, it is taken seriously by a large audience and influences the market. The same can be observed with interventions by large banks or central banks. For example, when economists from a major financial institution like Goldman Sachs predict a currency's appreciation, its value can quickly increase. Investors often follow such statements or movements, sometimes getting swept up in herd psychology rather than relying on their analyses. This dynamic leads investors to follow others' behaviors without using their knowledge, resulting in sudden market fluctuations and sometimes irrational movements. In summary, herd psychology plays a significant role in shaping investment decisions in Forex markets, and investors need to consider this when making decisions. In the Forex market, there are many intriguing points about how emotions play a crucial role in traders' decision-making processes. Investors integrate their emotions into decision-making while also being aware of the dangers these emotions pose. Emotions serve as a necessary feedback source when predicting market movements and taking risks. For instance, feeling the pain of losing can prompt more caution in risk-taking. However, a phenomenon known as the status quo bias can lead investors to stick with their decisions and maintain positions despite losses. Investors may emotionally commit to a position and persist in it despite changing market conditions. This creates a sort of emotional attachment to the position, making it challenging to make rational decisions. Ultimately, emotions significantly impact decision-making processes and market expectations in the Forex market. Therefore, recognizing, controlling, and overcoming these emotional attachments becomes an essential skill for successful trading. In the trading world, investors' psychological tendencies can heavily influence their decisions. One such tendency is known as the status quo bias. When investors have invested significant time and money into their current strategies, they find it difficult to change them despite new and better information. Just like the Concorde project, where the British and French governments became too attached to the project and continued despite losses, this exemplifies the insistence on a failing position. Another critical issue is overconfidence. Investors, especially after prolonged success, may become overly confident in themselves. This makes them prone to mistakes and unnecessary risks. For example, 90% of Swedish drivers consider themselves above average, which is statistically impossible. The same applies to Forex traders. Excessive confidence can lead to unnecessary trading activities and fluctuations. However, this confidence can sometimes help investors cope with challenges. Finding the right balance is crucial on the path to success. The decision-making process in the Forex market is shaped by a complex array of psychological factors, relying on intuition and experience. Intuitive decision-making is often seen as contradictory to logical thinking, but it's a skill developed through experience. Just as chess masters can make a move instantly based on intuition, experienced investors can make quick decisions based on past market patterns. This happens much faster than a conscious analysis, allowing traders to gain an advantage even in complex situations. In real life, investors making trading decisions must process market information intuitively. They use psychological shortcuts to simplify complex situations and reduce the amount of information they need to process. This enables them to make quick and effective decisions. For investors, intuition is gained through experience and generally doesn't require conscious effort. Successful traders can enhance their intuition, allowing them to make quicker and more effective decisions, while less experienced ones may struggle with new situations. In conclusion, intuition in trading psychology is a tool fueled by experience, facilitating quick decision-making. Successful investors develop their intuition to craft effective strategies even in complex market conditions. In the Forex market, it's quite common for investors to use cognitive shortcuts or heuristics to make quick and effective decisions. These methods help investors make trading decisions quickly based on limited information. For instance, the representativeness heuristic allows investors to evaluate complex market conditions more simply. However, using these methods can lead to erroneous outcomes because investors often assess the likelihood of two events occurring together as higher than the likelihood of them occurring separately. This is known as the conjunction fallacy and can lead to significant misjudgments. The most important lessons from this book are: 1. Understanding investor psychology is as crucial as technical knowledge in Forex trading. 2. Market participants' emotions and social dynamics play a significant role during financial crises. 3. Traditional economic theories often fall short of explaining real market dynamics. 4. Herd psychology and social influences significantly impact decision-making in Forex markets. 5. Emotions and intuition are critical in shaping trading decisions and market expectations. 6. Successful investors leverage experience and intuition to navigate complex market conditions effectively.